So why won't the Fed just cut interest rates? That's what we're going to talk about today. President Trump has been pleading with Chairman Powell to cut interest rates. He even threatened to fire him at one point, although he's since walked that back. So why haven't they cut rates? We're going to talk about what it's going to take, what needs to change for them to cut rates, and then why President Trump should actually be a little bit careful about what he wishes for, because there's a market dynamic with interest rate cuts that not a lot of people are aware of. But before we get into the video, I am Ryan Hartung, and I am a member of the research team here at the Macro Institute. If you enjoy this video, and if you learn something new, I would really encourage you to like and subscribe to the channel. Okay, so here's where we're currently at. Despite Trump's pleading, the market does not expect, it's about 10% chance that we'll see an interest rate cut at the next Fed meeting, which takes place on May 7th. So the market is pricing in a very little chance of Trump's desired outcome occurring. Now, if you look at this chart all the way back in September of last year, this was at 100% at one point. So the market was very sure that we would get an interest rate cut by May. And we're approaching May. We haven't had that. And so let's talk about what's changed. Before we get into the actual data, though, I think it's important to remember and go over what the Fed's mandate actually is. They have a dual mandate. So we've talked about this in one of our previous videos. On one side of the equation, they are trying to maintain the economy at full employment. And the other side of the equation is they want to keep prices stable. So they want to keep inflation around the 2% mark. Now, obviously, it's deviated wildly from there in the recent past, but that is their goal. They want inflation at around 2%. Now, the decision about whether the Fed cuts rates or hikes rates is very complicated. There's a lot of factors that go into it. However, I tried to break it down as simple as I could over here on the right. So the Fed generally cuts rates during contractionary periods when we have weak employment and low inflation. So rate cuts incentivize investing, incentivize spending, incentivize borrowing money with the goal of creating jobs and strengthening a weak employment market. And so that comes at the risk, as more people spend money, of an increase in inflation. But during those periods, the Fed is more worried about the weak employment side of their mandate, that they're willing to accept a little bit of risk of inflationary pressures, since generally speaking, when they cut rates, they're not that worried about inflation at that point. So even if it picks up a little bit, it's not that big of a deal. So that's when you expect a rate cut. You expect a rate hike during expansionary periods. So periods in which we have really strong employment and high inflation. So during those points, the Fed is more worried about inflation. So rate hikes incentivize the opposite of what rate cuts do. They incentivize saving money as opposed to, borrowing money or spending it. So that could have negative effects on employment, but during expansion periods, they're more worried about the high inflation than they are employment, because the employment market is generally strong. So with that in mind, let's talk about where we're currently at. Well, we're going to start with employment, and the economy is currently sitting at around full employment. This is generally not a dynamic you see for rate cuts. This is one of the lowest unemployment rates that we've had, going back all the way to 1975. So, if you zoom in on recent history, you could make a chart of the unemployment rate going up, but that's from a very, very low base of almost 3%. So the economy is at full employment. And like we talked about at the previous slide, the Fed isn't going to cut rates, generally speaking, when the employment market or the labor market is this strong. So that's where we're going to start when we talk about what could potentially trigger a rate cut. There would need to be signs that the employment market could deteriorate. And in fact, there actually are. So this chart shows this, and it's based on the spike we've recently seen in economic uncertainty. So in this chart, we see the Economic Policy Uncertainty Index advanced against the NFIB hiring plans over the next 3 months. I want to point out that the hiring plan series is actually inverted on the right axis in this chart. So when it looks like it's moving up on the chart, it's actually moving lower in reality. And so based on the relationship between these two data series, what we can see, when we see a spike in uncertainty, companies generally slow down their hiring plans, right? That makes sense intuitively. If you're a business owner and you're less certain about what the future economics backdrop is or brings, you're going to slow down your hiring. Now, how does that play when it comes to the unemployment rate? Well, as we can see here from this relationship, the expected change in unemployment next year from Michigan actually has a strong relationship with the unemployment rate. I also want to point out that the expected change in employment is inverted here. So when it's moving higher on the chart, it's actually moving lower in reality. And so here we see that these plans to stop hiring should be affecting the unemployment rate somewhat soon, right? The clip on the right does a good job of showing this, that we're, potentially months away from a acceleration in a negative direction, so a higher unemployment rate. So if you look at this series, you might say, all right, instead of threatening to fire the chairman of the Fed, maybe President Trump just needs to wait around for this data to take hold. And once the employment market deteriorates a little bit, the Fed will be more encouraged to cut rates. Well, not so fast, because you got to remember there's a whole second side of their mandate. So I just want to take a quick intermission here to remind you guys that we have a newsletter that comes out every single Monday called Macro Monday. So if you want to get your week started with economic content, this is the place to go. And I'm going to give you a little bit of a teaser of what you can expect if you subscribe. So we start with our one key chart that we're thinking about that week, and we include sort of some commentary on that chart. We then go into some key data series and how that performed in recent history, as well as some factor returns, just so you can have a general sense of what's going on in the market. It's great if you have clients or if you have a boss you need to impress. Then, this is the key one for me. I use this all the time. We lay out the calendar for economic data that week. This is super, super helpful. And below, we talk about both what to expect from this data, as well as some interesting tidbits, what's going on in some of the broader markets from an economic standpoint. So this part's really, really, really useful. Even though I help put this together every week, I'm still constantly referring back to this throughout the week. And then we add with some cool stuff too. So we have a macro job board if you're interested in, seeing what jobs are out there that's related to macro. And then here, sort of 3 articles or videos that members of our team, our research team, read or watched that we think could be useful or interesting to you. So yeah, this is our weekly newsletter out every Monday morning. If you're interested, I will put the link to subscribe in the description. And welcome back. We are on the second side of the Fed's mandate, and that is inflation. So as we currently, just to recap the employment side, employment market, full employment, very strong. Some data that shows some potential deterioration. However, when we look at the other side of the mandate, the inflation trends don't look very good. So consumers across the board are expecting higher prices next year. This is broken down by political affiliation. So let's just throw out the Democrats for a second, right? You could make the argument that that's not reliable data. Their guy isn't in office or girl isn't in office. And so they're upset. So, if you ask them, they think, the economy is going to be horrible and inflation is going to spike. Sure. Okay. You could throw out the Republicans under that sort of reverse argument. But we're not going to do that because look at the Republican series, right? It's actually shot up a little bit. Hasn't shot up as much as the Democrats have, but even Republicans at this point expect higher inflation, granted off a much lower base. You can see at one point they're expecting 0 inflation. But even that number has ticked higher. And even more telling potentially than that is what the independents suspect. So historically, when it comes to the inflationary data. Independents have stuck somewhat close to the Republicans in terms of trends, at least. But here you can see independents are alongside the Democrats. Consumers are expecting a much worse inflationary environment in the next year. And it's not just consumers either. Small businesses are also worried about inflation. So this is from the NFIB. It is the single most important problem series. As you can see, the businesses get a bunch of options here on the right. Anything from inflation, taxes, regulation, poor sales. You can read down the list. And they choose in this survey, what's the number one biggest thing that is currently posing a problem to their business. And so the chart on the left here is inflation. You can see it got up close to 37% following the pandemic, but it's not as high as it was then. However, there is still 20% of small businesses that view inflation as the single most important problem. So consumers are expecting greater inflation. Businesses are currently being hit by a lot of inflation. They still think that inflation is having a huge negative effect on their business. And we have not even mentioned tariffs yet. I actually want to applaud myself for making it this far in the video without saying the word. But unfortunately, I do have to talk about tariffs because we have not even seen the full impact of tariffs on prices yet. Now, some do try to question if tariffs are indeed inflationary. And before I go any further, I just need to say, yes, they are. That is the point of tariffs. It is to raise prices on foreign goods. So in the short term, you do expect to see price increases. Now, we don't have a modern version of really broad tariffs like we're seeing right now. You'd have to go back to the 1930s, the Smoot-Hawley Act, which I should say was around the time of the Great Depression. I guess we'll see. But we do have a more targeted modern example, and that is from Trump 1.0, when he put in some targeted tariffs in 2018. So these were things like washing machines, laundry equipment, steel, aluminum, etc. So not the broad-based, but very, very targeted. And if you look here on the chart on the right, we did see after the tariffs, it took very little time for this to happen. The cost of washing machines and other laundry equipment spiked. Now, we didn't see broad-based inflationary pressures because, again, these tariffs were very, very, very targeted. But we did see in the targeted areas, those prices increase. So I wanted to bring this back now that we've talked about both sides of their mandate. So as it currently stands, we'll do a little test. We've talked about that the employment market is currently strong, right? We're currently at full employment. There is some troubling data, but as of right now, things look pretty good. And on the flip side, consumers and businesses are pretty worried about and being impacted by higher inflation. And that's before we've even seen this tariff impact, whatever it ultimately looks like, work its way through our economy. So if you're looking at the two boxes on the right, strong employment and high inflation concerns, well, that is generally what happens when you see rate hikes, right? That happens during an expansionary environment. Now, obviously, that's not what we're currently experiencing, which is what makes the Fed's dilemma so challenging. The point here is that we're not seeing the data that normally lines up for when you would expect rate cuts, right? We don't have weak employment, although that could change. And so that is one thing that would need to change, is we would need to see a deterioration in the employment market, and we would need to see inflationary pressures subside. And, that, in my opinion, seems relatively unlikely until we have a better understanding of what this tariff regime is going to look like. Now, I said President Trump needs to be a little bit careful about what he wishes for. And that's what we see on this next slide. So, as I've mentioned a few times now, the Fed does not cut rates when things are going well, right? They cut rates when they expect economic contraction, right? When they want to boost the employment market. So We can look at three of the major cutting cycles across history. We have the early 80s, we have the tech burst in the early 2000s, and then we have the GFC in the late 2000s. And you can see a very clear relationship here that what the Fed rate cuts signified to the market was that things were not good. Right? So if President Trump is looking for a short-term boost to stocks or the economy, Fed rate cuts are not it, right? The market knows this. The market knows that the Fed's not going to cut rates if they're confident about how things are going. Now, there is an 18-month lag on Fed rate cuts, but it's not going to give the short-term boost that President Trump is looking for. I think he's going to need to turn in another direction. And if I may suggest one, I would suggest more certainty about what the future holds if he wants a boost to stocks and economic prospects. And that's what I'm going to leave you here with. Thank you for watching. If you enjoyed this video, please don't forget to like and subscribe. Talk to you guys soon.